In this video, we're going to debrief a business valuation question from the ICAEW question bank. The question that we'll be looking at is called CERN, so make sure that you've reviewed the question and had a go at it before you play any more of this video. You may also want to have the question itself to hand, as well as the answer that you've prepared. It is question 9 in your ICAEW question bank. As mentioned, it's called CERN. Before you go any further, you might want to just re-familiarise yourself with the requirements. So have a read through CERN's question and requirements 9.1a and b. Those are the only bits of the requirement that we're going to be looking through in this recording. Okay, so first up, what we're looking for is a net assets valuation. Now you'll notice it doesn't actually say in the requirement what form of net assets you want. Is it book values? Is it market values? Is it kind of replacement value? What? The clue with this one, I would say, is we know it's net assets. I would presume that it's market value for a couple of reasons. First of all, you'll actually notice in the notes to the requirement you're given loads of information about market value figures, so that would probably be a bit of a hint. The other thing is I would tend to not do book values unless you were specifically asked to, because book values are terrible. They are rubbish as a way of valuing a company. So again, you might be asked to do them in the exam, but I would probably only do them if you had to. So I think with this one, we're pretty safe at using market values as far as we can. Now there's no kind of set way that you have to do this, but given the fact we've got lots of bits of specific information on different bits of market values, I think you're probably better off doing this line by line. Okay, so if we have a look through their balance sheet, old school name, as at the 30th of September 2002, so if you've got the question in front of you, we can try and pull this together. Let's have a look. Well, first of all, intangibles. Now don't get confused about this. I know one of the drawbacks that you have of the asset-based valuations is that we don't include intangibles. Well, what we mean by that is we don't include internally generated intangibles. Okay, so if we were to buy the business, for example, or we were looking at a target business, an asset-based value wouldn't take into account things like their brand name and their special skills, their relationship with customers, things like that. So it would miss out on those internally generated intangibles. However, if we have intangibles on the balance sheet, they must be ones that this company has already bought in and therefore do have a ready value. So if it's on the balance sheet, they will not be internally generated. They will be external intangible assets. So they would be a legitimate asset to include here. Now, according to the balance sheet, they're in at £900,000. There's no other information given to us, so we can just assume that that is market value or as close to market value as we're going to get. Next up, as we work our way down the non-current assets, we have land and property. Okay, freehold land and property. Now, it's in for 1.8 million, but we are given some information about it. I think in note 4, it tells us the current rental value of the freehold land and property is £270,000 per annum. And it tells you specifically that this represents a 6% return. Now that's likely to be a 6% return on market value. So if that 270,000 represents 6% of the market value, it will give you the way of working out what the market value is. So take the 270,000, divide it by 6%, by 0.06, and it will give you the property, land and value from a market point of view of 4.5 million. Next up, we've got plant and equipment. That's in as 3.6 million at the moment, and there's no other information. So again, rather like intangibles, we're just going to have to assume that that's the correct value to put in here. There's nothing else we can do. Again, moving our way down, we've got investments. They're in at £900,000, but again, if we have a look at note 5 in the extra information, the current market value of investments is 1.35 million. And again, that's just been given to us, so we can use that figure, and it's going to be the right one, so that's nice. Now, moving our way down the assets, we have inventory, receivables, and cash. There is nothing in those current assets that is given to us in the notes. There's nothing that tells us that those aren't market value, that they're wrong, anything like that. So I've just lumped current assets together. So the inventory, the receivables and the cash, they'd already added it up for me just to make life a little bit easier. So I'm assuming that they're just all in as they are. Okay, that's the best figure that I've got is 1.8 million. So that's all of the assets that we've got on our balance sheet. To get to net assets, all we're then going to have to do is deduct the liabilities. So again, just work your way down the sheet. So we've got current liabilities of £1.08 million. Now again, just like the current assets, I don't actually have any other information on that. So I'm going to assume that they are just at market value, or they're worth market value as well, and we'll put them in. And then all we've actually got left is what we've got at the top of the next page. We need to look and see if we've got any other kind of longer term liabilities. Now there are two of them here that we need to take account of. First up, we do have some preference shares. Now I know that they're under the kind of equity section here, if you like. They're lumped in with ordinary share capital. But we do still need to take account of these as a liability when we're doing an asset valuation, because it represents a part of the business, a value of the business that is not going to be transferred to the new owner. So preference shares are going to have to come off here as part of the value. Now on the plus side, they're dead easy to work out. They'll never make this complicated for you. We've got 720,000 preference shares because it's 720,000 of nominal value and they're £1 each. So 720,000, and it just told you in note 2 that the market value is 90p per preference share. So out of the total value of the business, £648,000 is always going to be attributable to the preference share. So the new owner isn't going to get that. And then finally, we've got some long-term debt as well, proper debt. We've got our 10% debentures, and again, fairly nice calculation. We've got £1.8 million nominal value on our balance sheet, and we're just told in note 3 the market value of the debentures has been estimated at £110 per £100 of debenture, per £100 nominal value, if you like. You might see that in a question as quoting the debentures as £110%. Again, just telling you the same thing, it's £110 per £100 nominal value. So you end up with debentures at a market value of 1.98 million. So that's it. Work your way through kind of almost line by line, and just, you don't have to put an explanation for each one, but it's always a good idea to show your workings at least. So if you made a slight mistake, you might still get some credit. So what that gives us is a total market value of the company under this approach of £8,442,000. Now, just be careful with this one, because read how they want you to quote it in the requirement. It's often a little half mark point that people miss. It's asking you to calculate the minimum price per ordinary share. So you've just found the value of the company in total. You need to divide it by the number of shares that the company has. Now, the ordinary share capital is £3.6 million, £1 shares, so you've got 3.6 million shares in issue. So spread that 8.442 million over the number of shares, and you will get the price per share, which is £2.35. So that's what, if we were valuing the company on this basis, that's what the shareholders would expect to see as a share price that the new company, Fenton Holdings, should be offering us. We're going to talk about things like non-marketability discounts a bit more going forward. Non-marketability discounts wouldn't apply here because we aren't using any figures from other companies that are listed, even though we aren't. So if you're doing an asset-based valuation model, please remember you don't need to adjust for non-marketability discounts. Okay, the next valuation method that we're asked to use is the dividend yield. Now, if you remember, doing the dividend yield is normally a relatively friendly way of valuing a company. It's quite nice and easy to do, and we can do it in 2 steps. First of all, we have to find our most recent dividend per share. So we'll have to get that information for CERN. and then we divide that by the dividend yield from a similar listed company. So first up, let's have a figure out of what CERN's most recent dividend per share is. So if we have a look at the financial information that we're given in the scenario, we can actually pull this together quite easily. You should be able to spot that we have ordinary dividends that have been paid of £180,000. And if you have a look at the bottom of the statement of financial position, you should see that we've got 3.6 million ordinary shares in issue. So if you take the dividend, divide it by the number of shares, it will give you the dividend per share for CERN of 5p. Now, what we then need to do, like we said, is apply that to a similar listed company's dividend yield. Now, the issue that you've got here is that there are actually two different dividend yields quoted. So we found two companies that are similar to us, but which have different dividend yields. One had 4% and one had 3.4%. Now, there are a couple of different ways that you could tackle this in the scenario. I've not done both calculations here, although if you'd wanted to and you had time, you could have done. What I've done here is an average. So we've kind of said one of the companies is 4, one is 3.4, so the average dividend yield for a similar listed company would be 3.7%. However, in the question, it did mention the fact that we were looking to get the lowest valuation. So it would be possible, although the other company might disagree with this, it would be possible to also have just used the lower percentage instead. So whichever way you've tackled it is absolutely fine, because like I said, it was open to a bit of interpretation here. But in this case, I've just used the average of 3.7%. So all we're going to do to value the shares in CERN is take CERN's 5p per share dividend and divide it by 3.7%. Watch your decimal places. And that's going to give you a market value per share, in this case, of £1.35. Now remember, because we're taking information from a listed company and applying it to a limited company, there is that issue with non-marketability discounts. Now, you may see in some answers that they will just knock, say, about 25% off or so for a non-marketability discount. You could do that here, or alternatively, because there's a discussion section where we're going to have to talk about these valuations, you could just talk about it there later on. So up to you which way you want to tackle it. In this case, we'll build it into the discussion, and I've not taken it off here, but it does need dealing with somewhere in your answer. Our final business valuation approach is the PE ratio. Now, I have to admit, I think they've kind of overcomplicated this scenario somewhat. It's not impossible or anything like that, but it is a little bit awkward. So I wanted to go through it and just show you what they've actually done. Like I say, which is probably harder than you'll see in the exam, but just so you're aware how you could get it potentially. So the PE ratio means that we work out our earnings, so what is potentially distributable to our shareholders each year, and then we multiply that by a PE figure to get our overall market value. Normally we'd have to apply another business's PE ratio to ours. So normally as an unlisted company we'll have to steal a PE ratio from a similar listed company and apply it to our earnings, which is what we're going to do here. Now, in order to do that, we have to find what our earnings are. So what exactly is CERN's earnings? Now, if you remember, to work out your earnings, you're looking at what you can distribute to your shareholders. So we've got our profit after tax figure, which is great. That's what we could distribute. But some of that, if you have them, some of that profit after tax is going to have to go to preference shareholders. So normally our earnings would be our profit after tax less our preference dividends. Okay. Now, it kind of depends how you wanted to tackle this. There are a couple of different approaches, an easy and a complicated way of doing it, and they're probably both valid to a degree. The easier approach would just be to look at the most recent year. So what we could do is say, well, okay, let's have a look at the income statement that you've got in 15.1. We're actually given the profit after tax figure, and we're given the preference dividend figure. So you could just say, right, 747,000 minus the 43,200 preference dividend gives us the earnings that we need of £703,800. Okay, great, dead easy. Alternatively, what you could do, because you're given a little bit more information here, you could work out a more accurate approach. You could try and estimate the average figures that you're likely to receive, the average earnings for the last few years. Now this isn't wildly accurate for a number of reasons, but arguably it's perhaps more accurate than the first one. Because in note 1 they actually told you for the previous 2 financial years what the profit before interest and tax was. So what we could do is we could average that out to get a feel for what the profit before interest and tax would be for an average of the 3-year periods. Now, like I say, if you didn't do this, don't worry. You're probably less likely to get this in the real exam. But I thought, we'll pick a more complicated one and show you how it works. So if we look at note 1, well, we know this year's profit before interest and tax from the income statement is 1,080,000. Last year it was 440,000, and the year before it was 1.8 million. So the earnings are actually really very variable here. So that would give us an average, actually to be fair, not far off our profit for this year, or our earnings, profit before interest and tax for this year, of £1.106 million. Now, they've given you the profit before interest and tax, so you'd then have to kind of adjust that figure to get to the profit after tax and then to get to the earnings figure. So that's the average profit before interest and tax. So we'll have to deduct tax and we'll have to deduct interest. Now that interest, we've got the interest in the current year of £180,000, which I think is our £1.8 million debentures. They're 10% interest, so there's the 180,000. Now what I would say is, to get this to work, you're going to have to assume that the interest has stayed constant for the last few years. So we're going to assume the debentures have been there for the last few years, paying the same rate of interest. The other thing is, don't forget you've got to do this in order, because the interest is going to be tax deductible. So we'll have to take that average profit before interest and tax, deduct the interest, and then deduct tax off that figure. Okay, so essentially we've got the 1.1 million, the average profit before interest and tax, knock off the 180,000 of interest, and then we need to knock off the tax, which will be on the profit before tax but after interest. Okay, so you should find that our new profit after tax figure comes in at £769,134. So in theory that's more accurate because you kind of evened out those 3 years of profit before interest and tax. But like I say, you're going to have to make some assumptions here that, for example, your interest has stayed the same. And it tells us that our tax rate is 17% for the foreseeable future, but we'd have to assume the tax rate was the same for the previous years. So if you didn't go to the effort of averaging it all out, it's not really a disaster. And like I say, you wouldn't very often get asked to do something like that in the exam, but just be aware. If you can take an average, you probably should. So we've got our average profit after tax for the last few years. If we knock off our preference shares, our preference share dividend, that will get us our average earnings of £725,934. Like I say, you're much more likely to get that first style in the exam where you've just got it for a single year. But if not, like I say, there you go. You can work out how to do an average. So we've got our earnings figure, whichever one of those previous ones you've picked. Our next question is, what multiple are we going to use on them? So what PE ratio are we going to choose? Well, because we're unlisted, we're going to have to steal a PE ratio from a similar listed company who will probably have, will probably published them, or they could have easily been worked out already. Now, the information we've got about this is in note 6. The most recent PE ratios of two comparable quoted companies operating the same sector as CERN are 9.6 and 7. Now, the obvious thing to do would be to take an average of those two. Everybody loves averages in this question. So if one of them is 9.6 and one of them is 7, you could argue that maybe the best PE ratio to use would be 8.3. Alternatively, you could argue that the question asks you for the minimum acceptable price for the shares to CERN's shareholders. So if you're looking at a minimum, there is an argument to say, well, actually, the lower of the two is 7. That's a comparable company to us, and therefore the minimum would be 7. It doesn't matter which way you do this. Remember, business valuations are inherently open to interpretation. So as long as you can explain what you've done, just briefly, why you've used a figure, if there's any doubt, you often can't really be wrong as long as what you've said is sensible. So I don't mind which one of those two you've taken. So we've got two possible earnings figure and two possible PE ratios for you to use there. I would probably in the exam just pick one of them. So pick one approach. Don't try and do multiple valuations based on different assumptions. Make an assumption and just run with it. So depending on which combination of figures you've got for price and earnings, our total market value of CERN would therefore be, I'm only going to use the average figures from before. We said the average earnings was 725,934. So if you'd use the average PE ratio of 8.3, you'd be looking at 6,025,252, which gives you about 167 a share. Remember, you have to show it per share. Or alternatively, you could take the earnings figure and multiply it by 7 if you decided you wanted the minimum, which would give you just over 5 million or £1.41 a share. Obviously, again, if you've chosen to just look at this year's earnings figures, then you'd be using, they would be even lower. Okay. So overall, these are much, much lower than they were for the original valuation based on assets. Okay, so 167 or 141, but again, you may have come up with something slightly different depending on your calculation of earnings. Now, obviously, non-marketability discount is an issue, potentially here, because we are taking figures from listed companies. So because CERN is a limited company, that means our business is worth less than them, and therefore you would want to make a deduction here. To be fair, what that deduction is up to you. Realistically, a common non-marketability discount assumption is that it will be around 25% that we would knock off because we're a limited company. Now, it's up to you how you want to do this. You can either show the 25% deduction in your workings here, or alternatively, if there's a discussion section that you're going to go on to talk about it in later, which there is in this scenario, you can mention it as an issue there. Okay, so either way, you probably won't get marks in both places for it, but choose one or the other. Okay, as long as you make some mention of it somewhere, you will get credit. I do just want to stress to you, non-marketability discounts are always an issue if you are a limited or an unlisted company and you're taking figures from listed companies. So there'll always be kind of a 25% deduction there. In reality, we're estimating 25%. The deduction is very variable. You're not going to know for definite in the real world what that figure is. It's just a guess, if you like. So we've got our valuations, which is great. What we're then asked to do is comment on them. Comment on the values that you've calculated and any issues you think should be brought to the attention of CERN's directors. Now, let's look at our valuations one at a time. So first of all, let's look at the asset-based value. Now, it's not just asking you to criticise it, it's asking you to comment on the value. So that can be positive or negative points. However, the asset-based valuation is likely to have a number of negatives that you can have identified. So, for example, much of the valuation is still based on historic cost, so it isn't necessarily reliable. It could be out of date. So, for example, we've got intangibles of 900,000, if you remember. There was no information on whether that was a market value figure or not, so have we included the right number, what it's actually worth? And the same with things like inventory and receivables, and our current liabilities. Are they all actually at market value? We don't know. If they're not, then that would make this valuation inaccurate. As we touched on before when we were chatting through the first set of figures, when we were doing the asset-based approach, the other problem is it ignores internal goodwill and intangibles. Again, if you can, just try and briefly explain these points in a sentence or two. So for example, CERN's brand name is presumably valuable, it's making a profit. That wouldn't be included in this valuation, and yet actually it could be worth quite a lot of money for a successful business. So we're not even looking at all of the assets of the business when we do this. So there are two very big drawbacks there for the asset-based approach. The one positive for it would be you would use this as a valuation for the entire share capital of a company, because this is looking at the value of the assets which you're doing. So this really applies to controlling stakes of a business. Okay, it looks like Fenton is planning to buy, in this case, the whole share capital, so it's planning to buy a controlling stake in the business. So in that way, the asset-based valuation would be suitable. Next, we have to think about our discussion points relating to the dividend yield valuation that we worked out earlier. There are a number of potential issues with using the dividend yield valuation. They're kind of similar to some of the other ones that we're going to talk about with the likes of the PE ratio further down the line. So things you could have mentioned in your answer. Don't forget, what we're assuming with the dividend yield is that the pattern of future dividends is going to stay relatively constant. It's unclear in this scenario what the dividend pattern is going to be. We only really have information from 1 year's dividends. Is that consistent with what normally happens? Is that what's expected to happen? We don't really know. So the model kind of assumes that the dividend pattern is going to stay fairly constant into the future, and that yield is therefore going to be appropriate. That may not be the case necessarily. We don't have enough information to come to that sort of conclusion. We've taken the dividend yield from similar listed companies. There's a big question about whether they are actually similar or not. Don't forget, if these companies are different in really any way at all, then using their dividend yield and applying it to our company is also going to be inaccurate. Now, we didn't take account of the non-marketability discount when we did the calculations earlier, so I mentioned it here. Again, the non-marketability discount is only an estimate anyway, so we would need to take that into account. Like we say, we normally knock about 25% off for a non-marketability discount, but in reality, that may not be the right figure. We don't really know. And finally, the other thing to remember is this would normally only be used for valuing a non-controlling stake. If you were looking to sell CERN as a whole concern, then this probably wouldn't be the right way to go. Next up, we've got discussion points about our PE ratio. The great thing about looking at the PE ratio calculation is that you can criticise pretty much every single figure in it. So, first of all, let's have a look at the earnings figure. Even though we've adjusted a little bit in our example by trying to kind of average out the profit before interest and tax for the last 3 years, you'll notice that actually the earnings for the last few years have been really variable. With a PE ratio, what we're assuming is that those earnings will stay constant for the foreseeable future. So they will never change from whatever earnings figure we've used in the calculation. Now you can see that given how variable our profits and our returns actually are each year, there's a good chance that that is not right. So we will probably have quite radically different profit figures year on year going forward, which would make our valuation inaccurate. The PE ratio we've chosen is probably wrong. It's not perfect. We've taken PE ratios from similar listed companies. How similar are they? Are they the same scale to us? Do they do exactly the same thing? If there are any differences between us and those businesses, again, it's going to make the valuation inaccurate because we're different to them, so we would have a different PE ratio applied to us. You can even criticise the non-marketability discount here. We don't know what the non-marketability discount would be. We're assuming 25%, could be a third. We don't really know. Again, that's just an estimate. So every number that we've actually put into this could be wrong. And because of that, there's a real chance that actually the valuation isn't perfect. Again, though, it's worth saying the PE ratio looks at the earnings for the whole business, and you'd control those earnings if you bought a controlling stake. So, again, the PE ratio would be used for a controlling stake in the company, which is appropriate for this acquisition because they're going to buy all of our share capital. If we were buying a minority stake, this wouldn't be an appropriate one, and neither would the asset-based approach either. So overall, let's just make sure we're kind of concluding here and answering the question. It's asking us to comment on the values you've calculated and any issues you think should be brought to the attention. There are a couple of things you could have also said somewhere in this answer. One of the main things is remember, as we've touched on, there's not likely to be a correct valuation for this company. There never is. Ultimately, there's always going to be an element of judgment and or error in your calculations. So remember, whatever valuation you've come up with is only going to be a starting point for negotiations. The final price depends on the relative negotiating strength of the two parties. So for example, if Fenton is really keen to buy, they will pay a higher price for the shares. If CERN's shareholders are desperate to sell, they will accept a lower price. Okay, so it's only ever a starting point for negotiation. However, it is probably also worth saying, if you actually look at the valuations that we've done, that the two that we had a look at, the net asset valuation gave us £2.35 a share. The price earnings valuation gave us, I think at worst, kind of £1.41 a share, possibly less 25% for a non-marketability discount. So the asset valuation would suggest quite a high value compared to your PE ratio. If that means that if those are accurate, it may mean that the business actually has more value in its assets than it has as a going concern. So it's possible that the shareholders may prefer to actually break the business up and sell its assets off separately. Now, in reality, both of these methods that we've looked at do have significant problems attached to them and significant inaccuracies. And while it's not perfect, what you might find is that both parties could well find that a discounted cash flow valuation would be more acceptable. It would give you a much more realistic value of the business and its earning potential going forward. Now, we weren't asked to do that in this scenario, but obviously that is something that you could quite easily do as a business. Okay. Now, you'll notice with this, just the last thing I want to say, you'll notice with this that you have 13 marks for doing 3 business valuations, even though we didn't look at one of them. And you've only got 4 marks to comment on your valuations. In your exam, it's much more likely to be evenly balanced. So you're as likely to get you're likely to get as many marks for the discussion points as you are for doing the actual numbers themselves. So what I would say to you when you're doing these, don't neglect the words. Make sure you're able to explain the good and bad points about valuations and make sensible comments surrounding them. They need to be applied to your business as well, as much as possible. So have a look at this situation, have a look at these valuations, have a look at the company itself and decide what you think is appropriate or not. One of the best ways of doing that is just try and mention the name of the company in each point you make. So mention CERN's name, for example, as often as you can, and it'll often kind of bring you back to the scenario and force you to apply your points. Anyway, that's the end of our requirement. That is a business valuation question. Hopefully this walkthrough has helped you see what you need to do and just kind of guided you through the process.